today with Martin Coen, CEO of Dovetail. So what are the biggest trends you see in the payments market at the moment? How's this changed over the last year or so?
Well, I think the overall environment is very familiar to everybody in payments. We're seeing increasing volumes in transactions, albeit with increasing margin squeeze. I think there's a sort of relentless sort of wave of regulation coming through and no expectation of that slowing down. And I think there's a landscape of consolidation both within the banks and the relationships between their clients and the banks themselves. But that's the environment. That's given and fixed for everybody playing in the payment space. I think the interesting part on top of that is how different banks respond to that and the trends that we see there. So where we see strategies of banks that are winning and moving forward and taking market share, where we see others that have been less successful, and other banks, I guess, who are more guilty of inertia and not responding to the changing landscape around them. So we're seeing the banks that are moving early and consolidating their payment operations onto payment services hubs already getting some significant advantage in what they're doing, not least in the Sepa space, where the move towards more regional offerings and more scale and connecting that into the domestic offerings in a way that is sort of helpful for their clients is giving them a big advantage. And quite a number of the large mandates within the Sepa space now have moved on the basis of banks that have that forward-looking vision of where they're taking the payments operations.
Would you say the Sepa deadline is irrelevant then?
Not entirely, but in some respects, yes. And I think banks that are focused solely on the end date are missing the point. So credit transfers are in place, the plumbing is there, and now the volumes that come on that plumbing when the taps get turned on is not in the control of the receiving banks. And we've seen a number of banks already in the market who've developed a first solution or platform for their Sepa payments have now gone down the path of revamping those or changing those solutions to other providers to provide them with the scale that they require. I guess just as interesting, maybe more interesting in the direct debit space, we're seeing the client mandates going out very aware of Sepa in the market pre-end date and wanting to understand from the banks how they're going to address those changes. And I think that brings out a sort of an obvious commercial point, is that when large mandates move, they move for a period of time. And those mandates that are moving now are moving on the assumption that that relationship will be in place post-end date. So the judgments that are getting made now about who to choose and who the best bank is to provide my payment services as a large client are going to be based on a post-end date world, not a pre-end date world. And that timing is not too sensitive to the end date. If the end date moves back and forth a little bit, it isn't going to change the way those mandates work. So what we're seeing is the banks that can demonstrate today that they have the capabilities to handle large volume Sepa processing are in a much, much stronger position with those mandates than banks that are saying, we are going to go through some development between now and end date, whenever it may be, and provide those services. So again, we're seeing really quite a difference in timing in the market, depending on the commercial reality and when business moves, as opposed to when the regulatory events themselves occur.
From your vantage point, what are the progressive banks doing and thinking about now?
Well, I think the key trends that we're seeing going forward now from what we've been discussing already is around information, and particularly around banks offering out much more holistic and much more real-time information, and the way that they're beginning to connect that information with other services that relate to payments. And this is, I guess, classically what transaction banking should be, and it's pulling together much more value add from the raw payment flow and the information related to it, and it's making the relationship itself much more sticky. So they're giving banks an advantage in selling a broader bundle of services out through that. And I think that really is the trend that we'll see now in the next few years, is transaction banking coming to the fore, both for the global transaction banks that build very large-scale infrastructure, but also much more regional transaction offerings that are providing more specialist services out to geographic or market segments. And I think if you take some examples of how that value add can get put onto payments that look sort of on the face of it to be fairly sort of mundane or low margin, the area of ACH and bulk processing is quite interesting in that we see an increasing demand around FI clients for real-time information around bulk transfers, which they're willing to pay for, even though the ACH payments themselves are pretty much free. And we're also seeing that the capability and understanding of how to handle information in ACH bulk processing is providing an advantage in moving into the space of global disbursements, where banks are able to take out FX and have much larger margins on those services. But the value or the services they can provide to their clients are very related to the way that they can do or manage information in a bulk ACH way. So the crossover there is becoming really quite relevant. I guess we see also a theme, not too surprisingly, around intraday liquidity. And again, an interesting crossover between what is initially a regulatory requirement coming from ILA in the UK or from European Central Bank in trying to make clear reporting out on a more intraday basis. We're seeing banks see the advantage of taking that and putting that out as a service, so providing increased intraday liquidity information to their clients, and again using that to provide more value in the relationship, allow them to hold more margin and to make the relationship itself more sticky. I think going forward that trend in information is only going to increase, and one of the interesting sort of milestones not too far down the line in this is the move, or the expected move, of Target 2 to 2022. So there are mandatory reasons why that will happen. The ultimate beneficiary will now start having to be transferred through Target 2. So banks will have to make the move. But the smarter banks are going to use that move and the extra space in those messages to provide increased information services. So I think, just to sum up, this is all about putting more information and using that information in value add to hold a sort of a broader relationship with clients, and using that to sort of drive more value add and more stickiness out of those relationships.